global financial markets stumbled after taking the jolt from a plan to bail out banks in Cyprus, with the developments rekindling worries about the European debt crisis. Over the weekend, European officials unveiled a proposal for Cyprus to tax all of its bank depositors in order to help fund its bailout. Share prices initially fell in Asian and European trading on Monday. By the end of the day, however, the verdict was mixed. Investors were unsettled but didn't react as if a major intensification of the crisis was at hand. In Europe, shares were lower almost everywhere on the continent, and bonds of troubled countries weakened, but there were no signs of broader unrest outside Cyprus. The euro declined against the dollar, its first loss in 3 days. In the U.S., stocks fell at the opening bell, with the Dow Jones Industrial Average at 1 point sliding more than 100 points. After seesawing through the afternoon, the Dow finished down 62.05 points, or 0.4%, to 14,452.06. The market reaction, though modest, runs against policymakers' efforts to reintegrate the Eurozone, to lure investors in stronger countries back to the weaker countries' markets they rushed out of at the peak of the financial crisis. Spanish, Italian, Portuguese and Irish government bonds dipped Monday, and German bonds benefited. The concern is, what if this isn't a one-off? Said Larry Peruzzi, director of international stock trading at Cabrera Capital, the brokerage firm. What if European policymakers start doing this to Spain, in Greece, to all the other members that are having debt issues? Cyprus put off parliamentary debate on the proposal to tax all bank depositors, and banks were set to remain shut at least through Wednesday while lawmakers decided how to proceed. The agreement is not yet set in stone, and there is still time to redesign the plan so that small depositors are spared, said Gareth Berry, the currencies analyst at UBS/UBSN.VX -2.00%. Still, he said, it is unclear if pulling back from the brink now would be enough to undo the damage. Also worrying investors is what comes after the bank tax, assuming it is passed by Parliament. Some depositors might pull funds when the banks reopen on the fear that another tax could come down the road if Cyprus needs more cash to fill budget shortfalls. We do still have a problem here, said Paul McNamara, investment director at GAM, a London asset manager. We need this tied up fairly quickly. People were looking for a reason to take some money off the table, and this has given it to them, Mr. Peruzzi said. And for some, Monday's slide was a welcome development. Many of Cyprus's foreign bank depositors are Russian, and that country's shares were among the hardest hit, with the MICEX index slumping 2.2% to its lowest level of the year. Russia stands to be one of the biggest losers from the deal, said Lazy Armalenko, emerging markets economist at Capital Economics. If the deal goes ahead as currently proposed, Russian depositors may lose around $3 billion. In the bond markets, investors headed to the safest bets. German government bonds, perceived to be the safest in the euro area, saw prices jump in early trading. The yield, which moves inversely to the price, on 10-year bonds hit 1.37%, its lowest level of the year, though it later settled at 1.405%, down 0.05 percentage point on the day.